Welcome to the weekly market analysis for the week of July 14 to 18, 2025. This past week saw Dalal Street exhibit a fascinating dichotomy. While large cap indices experienced a dip, smaller indices like mid caps and small caps demonstrated remarkable resilience. This segment will delve into the critical factors driving the divergent trends, the performance of various sectors, and what this development signify for investors navigating a market shaped by both domestic pressures and global optimism. The Indian stock market painted a mixed picture this past week. The benchmark Nifty 50 closed lower at 24,968, registering a decline of approximately 0.72%. This dip was primarily driven by weekly quarterly earnings, uncertainty surrounding a potential US India trade deal, and mixed signals from the US Federal Reserve regarding interest rate cuts. Conversely, the smaller segments of the market shone brightly. The small cap surged by 1.5%, while the mid cap index gained a respectable 1.03% amidst supportive global views. This divergent performance highlights a shift in investors' focus towards segment offering a better value propositions. Several key factors influenced market sentiment during this week. Firstly, weak Q1 FY26 earnings, particularly from heavyweight financial and IT sectors, significantly impacted large cap performance. Adding to this pressure, foreign institutional investors remained persistent net sellers, offloading over 3,694 crore rupees worth of equities between July 14 to 18. This trend reflected a growing global uncertainties and concerns about elevated Indian equity valuations. On the current front, the Indian rupee weakened from the fifth consecutive month, influenced by foreign outflows and global currency trends. Brent crude oil hovered around $70.03 per barrel following geopolitical tensions and supply concerns. Furthermore, India's GDP growth slowed from 8.6% in Q3 2024 to 6.2% in Q3 2025, reflecting a broader economic moderation and contributing to the recent correction in Indian equities as a response to elevated valuations and macroeconomic headwinds. Sectoral performance revealed a clear divergence this week. The Nifty Media Index was a standout performer, closing with a robust gain of 3.92%. The rally was likely fueled by strong stock specific performances and re-evaluation of media stocks. Also showed gains in Nifty Realty around 1.95% and Nifty PS Bank around 1.75%, supported by improving fundamentals. On the other side, the Nifty IT sector was the worst hit, declining by 1.46% due to subdued Q1 FY26 earnings and the cautious outlooks from major IT firms like TCS. The Nifty Private Bank Index also experienced a significant decline of 1.93%, driven by weak results from the leading private banks. Additionally, the Nifty India defense sector faced heavy selling pressure, losing 4.1% amid valuation concerns and profit booking after a recent strong run. Technical analysis of Nifty 50 reveals key levels to watch. Nifty has immediate support at 24,877, a major support at 24,651. Immediate resistance is at 25,102 and later at 25,328. The index is likely to remain in a sell on rise mode unless it breaks about 25,210 with volume sales. The recent correction is seen as a response to elevated valuation and macroeconomic headwinds. Expert opinion suggests that while short-term challenges exist, the correction might also present long-term opportunities in quality large-cap and value-oriented stocks. The analysis is based on the information available as of July 18, 2025, and market conditions are subject to change. Investors should consult a financial advisor before making investment decisions. Thank you for watching this detailed weekly market update. Stay informed, stay cautious, and check back next week for more market analysis.